Hi, friends. Welcome back. So, this was the headline this week. Helene insurance losses likely in billions. And we're talking about a storm, Hurricane Helene, hit the southeast part of the USA. And I've been looking at the pictures of stuff and reading about it. And unfortunately, the damage is pretty awful. And if you or your friends or your family have, property down here, your homes down here, please let us know that you're okay or just how things are going. I want to go through this stuff because I think it's an important topic that people don't talk about enough in a serious way and talk about it in a way that is sort of preventative of losses. Unfortunately, on YouTube, there's so many channels out there that just say, all your riches are going to be in real estate. Buy my scammy course. I mean, we talk about this with other channels that try to sell you, courses that are like hundreds of dollars a month. And something I always mention is, guys, nothing is guaranteed, be it stocks, real estate, any type of investing, and understand the risks that you face and take this stuff seriously. This is all about managing your money, is taking risks seriously. So I'm showing you this picture first. It's interesting because, and I don't know how many places in the world do this kind of thing. And for those of you who are watching outside the US, you can let me know if you've seen this kind of stuff before. But some people, and this is Florida, I think, Horseshoe Beach in Florida, they built their house on stilts. So they're so close to the water. I guess, this is a common thing where the water can, overrun the land. And essentially, if your house is high enough, theoretically, you can survive. So some of these houses did survive. But as you can see from the debris, some didn't, right? And in this part of the world, unfortunately, like the insurance companies won't cover you. This particular one is Georgia, though, but it's not just Florida. So it's multiple states. And whether or not you have insurance in this thing, you could lose everything. The damage can be really, really awful. For example, this person there in Florida, also too, it says Stenhachi, and you guys can just see like how awful this would be to try to clean up. Other things that can happen too in this area is it's not just your home damage; it's also your road damage, power, sewage, etc. You could get hit by a tree, and again, the damage of this stuff would just be awful. My understanding of this stuff, I was looking at these things, is that I guess insurance costs are through the roof. We're talking about climate change, extreme weather, these kind of things. So the insurance companies, they have the numbers. Like, they know how much the damage is, they know what the likelihood is, and some of these companies just won't even insure you at all. It says here that your premiums, I guess, in Florida have gone up 45%. This is just the last couple of years. And the average amount that a homeowner pays is about $5,500. So that's 140% higher than the rest of the country. So other parts, the average is like, $2,285. And then some places like in Florida, they pay around, this would be more expensive, but like $20,000 a year in insurance, which is really a lot. I want to talk over this stuff, and you guys know my channel is really different than other channels on YouTube. Lots of channels on YouTube tell you you're going to be rich in real estate. Just buy my scammy course. We'll tell you, how awesome it's all going to be, and you're going to have Airbnb, etc. But I think it's important to talk about risks. And a big part of managing your money is managing risk, right? So for me personally, because I've lived long enough, you guys know, I always mention my age because you'll see things with experience. It matters because like I've seen it so many times where storms hit this part of the country, and I'm just like, I'm never living there. And that's just, there's many reasons, but just, I think just money reason alone, if I'm in an area where my home could be destroyed, it's just not worth it. Now I know there's some people, and this is sort of where it gets, sensitive and complicated. They can't leave for different reasons. Everyone has a different reason for that. Or they won't leave, right? There's again, different reasons for this stuff. We saw the movie Twisters recently. It's actually a pretty good movie. I actually was really impressed with the movie. They did a good job. The first one was just okay. The second one I thought was pretty good. One of the reasons is because they spent a large portion of the movie talking about people's lives and property damage, right? Because again, guys, when you're talking about real estate, you can lose everything. I grew up in Oregon, and part of sort of your views of the world reflect on what you grew up with, like what you've learned as a kid, and sort of then the values you hold and sort of how you see the world. So for us, and I'm bringing this up, anyone who's grew up in the Pacific Northwest, you can give a shout in the comments. You'll know exactly what I'm talking about if you're of a certain age. And if you're younger, I'd be curious if they teach you this when you're younger. So I remember this stuff because it was during my childhood in the 80s. This thing blew up in 1980. This was Mount St. Helens. I don't know if you would classify it as a volcano. I'm not an expert on mountains, but I have actually hiked through here. The thing exploded in 1980, and there were lots and lots of warnings. And the story they always teach you in Oregon is about the guy who wouldn't leave. His name was Truman, and if I remember correctly, I think there's like a monument there. It's a long story necessarily why. I think he was like 80, and he just he was old and just didn't want to leave. But he was probably one of the first people to die, and it wasn't like he didn't know. It wasn't like people didn't know. It wasn't like people wouldn't warn them. It's just some people won't leave for whatever reason. I don't want you to be one of these people, right? If someone's warning you about something, take it seriously, especially be it risks in stocks, be it risks in real estate, etc. Take this stuff seriously and acknowledge that it's there. So, for example, this is sort of why, every day when we go to the news, I try to cover as much as I can to give you guys a good, risk assessment and sort of like what expectations are on anything, be it real estate, stocks, etc. Because the idea of managing your money is you're sort of allocating funds that, come in each month and saying, okay, what risk level am I comfortable with? Am I okay with things going down, 30% or whatever? Am I okay with things going to zero? If not, if that kind of money you can't afford to go down, then you put it in much safer stuff, right? Do you see what I'm saying? So oftentimes people like focus on just how much money you're going to make, et cetera. But I think you want to focus on both. It's the same with if you're going to buy a home in Florida, right on the water, and you're like, okay, well, I'm going to buy these stilts and I'm going to, just do that. Like at least that the risk is there, opposed to, people are like, oh, I'm going to buy the home on the water because it's pretty and look at how pretty it is, right? So you want to take this stuff into consideration when you're allocating funds. So another example would be like, okay, I always talk about, just buy, one of the safest ways to invest in the market is just buy, an index fund into the S&P 500. And I want to show you this. This is actually the predictions or projections, I should say, of what different Wall Street banks or some of these are hedge funds, I think, are also sort of predicting towards the end of end of this year where the market could go. I think right now the S&P 500 is trading at, I want to say it's 5,700. I thought I had it right here, but I think it's 5,700 right now. And so these are projections. I'll leave it on screen, but I'll just read through it kind of quickly. The higher end was like BMO Capital, Evercore. They're saying like 6,100, 6,000. A lot of the ones like say Wells Fargo, Citibank, Goldman Sachs, they're kind of like predicting flat. So from 5,600 to 5,500, and again, I think we're like 5,700 now or something like that. And then you have like some towards the bottom, Fundstrat, Cantor Fitzgerald, HSBC, JP Morgan. They're all like low 5,000s. JP Morgan, I'm not sure. They have a number at 4,200. I'm not sure if that's a typo maybe, or maybe they are predicting that drop. But the reason why I'm just showing you guys this stuff is, again, you manage your risks, manage your expectations, and that's a big part of success with investing. One of the things though, and this is sort of where it's always a sensitive topic when you talk about this stuff, but it's a very important topic to talk about because the way our system is going, if you're not paying attention to the market and these kind of things, you're gonna get left behind because the wealth cap keeps growing. This is something right here. It says the percentage of how they define this. I'll read it. It says U.S. households equity allocation as a percentage of households' total financial assets. I know it's kind of a word jumble, but it's basically like percentage of say your net worth is how much is in it is in stocks. And we're actually at a very, very high amount. So according to this, we're at 34% of average Americans, how much of their money is in the market. Like 34% of it, right? So I mentioned this guys before, sort of like how, be it for good or for bad, much of like why we see markets going up is like people keep dumping more and more higher portions of their wealth into it, right? So more people are invested in it, and moreover, if you do have assets, right? Your overall net worth keeps going up, right? Be it your home, stocks, etc. This can be due to inflation, and again, because of more people are putting money in said things. The unfortunate thing about this, and the reason why I say unfortunate, is why do I say the gap is getting wider between rich and poor? Is because the poor people don't have these sort of assets. Now, someone wrote in the comments saying, "Oh, Chris, are you suggesting for poor people to get rich, they have to buy assets? You're being insensitive." Someone actually wrote something about that, and And it was like, it's because I get the point they're trying to say, because they're trying to say, well, poor people can't even, afford to pay the rent. Why are you talking about, buying houses and buying stocks? Well, this is sort of why we try to talk about everything on here, right? So I brought up the dock workers going on strike, or say, for example, there's a Hollywood strike. These things, because I acknowledge it, guys, I completely get it. Things are really expensive right now, right? So as I always say all the time, first you gotta focus on making sure you have job skills and a job that pays enough money so that you can meet the needs that you have each month, and then you have extra money to invest to grow your wealth, because you can't ignore the wealth building part, right? Just wages alone and thinking that's gonna get you to the promised land is not the case anymore, right? So it's because, and just the way our system works now, everyone's throwing their money in the market, and hence since everyone's doing it, you kind of have to do it too. It's kind of a crazy situation, but and then you go back to why I show you guys the risk management. So okay, if that's what everyone's doing, is how long can that trend continue? That part I can't predict. I mean, I can't predict, like, are we going to be where, suddenly 50% of our money's in the market? I mean, we're at like the highest levels in history. So that, the past, maybe that will end up being a bubble and will crash, et cetera. But again, it's all about managing risk. So that's why I show you guys some of the Wall Street projections. Going back to this stuff though. So, and I talk about this stuff in my book. I mentioned before several times in the channel, and this is, again, it's called Positive Angle. It's on Amazon. The reason why I mention this stuff is because for those of you guys who read my book, and I can tell you a little about it, I grew up around, these kind of workers, essentially. The generation of, it'd be 2 generations above me. A lot of the Americans moved out to Oregon, Washington, et cetera, during World War II era, from the Great Depression. They got jobs in World War II era to essentially be longshoremen and work on the ships in the shipyards, these kind of things. So I understand this kind of thing. And for some people, the families that did really, really well, they worked essentially a blue collar job, got paid a pretty decent living, right? And then just started buying up real estate. A lot of people did, because back then, like, it was just a different era. The real estate was really, really cheap. There weren't that many people, and the demand wasn't there. And so, it's funny. I'd heard so many stories of people who were like, oh, I wish I would have held onto my real estate land, et cetera. And because they bought it for like a couple $1,000s. And, if you held it long enough, then suddenly when the shopping mall comes and buys the land from you, et cetera. And I've heard these stories, several times. But that's just on just people just having land, right? So point being, investing your money in that situation, real estate, end up paying off really, really well. The same way as today is, it's a combination of stocks and real estate, et cetera. I'm bringing up the dock worker situation, or Hollywood, and I'll explain these things in a second, is because oftentimes around these kind of workers, guys, I've seen it firsthand, is some of these people, they just go out and they just like buy Cybertrucks, just for example, and or whatever hot car. I remember back when I was a kid, there was a friend's parents, I remember, and the dad would always buy like the fanciest sports car, right? They always get the fanciest sports car. And it's kind of ridiculous, because this is the reality. A lot of people out there actually can afford the sports car, but it doesn't mean you need to buy the sports car, because you end up losing quite a bit of money on insurance and maintenance, et cetera, et cetera, et cetera, opposed to, say, buying something that will go up in value over the time, be it real estate, be it stocks, et cetera. And the reason why I want to show you the risks in this stuff, because I don't want to ever imply that real estate is risk free and you have to do it and all the cool kids are doing it. So I don't want to necessarily imply that, because it's not guaranteed. Nothing's guaranteed in this life. And so that's why, as I tried to say to you guys before, when you want to manage your money well, is also managing your risks. This is an example, and this is also too, everything comes with your experience. So if you guys don't know, I used to work in Hollywood, and sometimes when you ever bring up, Hollywood's going on strike, for people who've never been there, they just think everyone in Hollywood is like, billionaires and making tons of cash, etc. Sure, maybe Tom Cruise is, right? But like Tom Cruise makeup artists, or the janitor that cleans up after Tom Cruise, the cook, for example, that cooks the food for the crew, these kind of things, like not everyone necessarily is getting the Tom Cruise type of salary, right? Or in this situation, the writers, some of the assistant writers, or even just main writers, they just don't get paid that much these days, compared to the cost of living, right? It's how can I say, even in this world. So for example, I have a friend I don't know what his particular job is right now. I think he might be a coordinator or something like that. I just don't know, because these kind of people it's a lot of it is you have to change jobs every couple of years. What if your show gets canceled, etc. It is really a tenuous business. And he went out and he got a Tesla, right? And then ended up losing his job. I'm not sure if he's working now. I don't, maybe not. And I think he went back home and lived with his parents at the moment. And so for me, I try to manage risk. I just don't think that you necessarily want to overcommit all the time, meaning that take out big loans for your car, thinking that you're always going to have a job, because what if things go wrong? And I know for some people, it's not fun to talk about insurance losses and talk about possible storms in your house. But again, this is all about managing your risk. One of the things too I wanted to bring up is the wealth disparity. Again, if you don't pay attention to this stuff, you'll get left behind, right? So one is, if you are working class and you're trying to save up, is manage the amount of money that's going out and try to live below your means. So you're putting money aside. This one actually put it much higher than the other one I just showed you, and the numbers, I think maybe this is a more updated number, but they're saying like percentage of U.S. households that have stocks. I guess it's 41%. So a lot of people do. And there was another number in here, and I don't know if I can find it quickly. Oh yeah, it's right here. This is actually a really interesting one. This came out at the beginning of the year, and I'll just read the headline. Top 10% of Americans held 93% of all stocks. It's pretty crazy. Top 10% of Americans held 93% of all stocks. Here's the other one. Meanwhile, the 50% of Americans held just 1% of all stocks in the third quarter of 2023, right? So if the market keeps going up and real estate keeps going up, and you guys can get what's going on here, is you're going to get this major disparity in wealth. And this creates a lot of problems to society that you do want to pay attention to. And you also want to be, and this is just reality, I'd rather be in the top 10%. And I don't make jokes about this stuff. I just want to be realistic about this stuff. Like, if that's our system and that's how it goes, you gotta be part of the system. One of the things that's happening is as well, and again, this gets complicated stuff. This also gets disparities by race in terms of wealth. One of the things that actually it turns out is interesting is if you're Black or Hispanic, much of your wealth ends up being in pensions, I guess, because you're more likely to be a union worker. That's what it was saying here. And they use Black as an example, but I think Hispanic fits as well, because they're talking about who owns stocks or not. And I'll read the description of this so you guys can understand. It says here, much of the divergence in net worth by race and ethnicity since 2019 can be attributed to the divergence in real values of financial asset holdings, right? It says they're including the fact that Black households have more wealth concentrated in pensions than in stocks, mutual funds, traded funds, or ETF, right? So essentially what we're saying is, like, yes, you got your money in pension, but the people who have their money in stocks, your wealth is actually growing faster, and you're having sort of a big disparity there. And I wanted to bring that to your attention, because some people say, well, I work, I have a job, and why am I not getting ahead? It's just the way that your wealth is structured. So I hope this talk is important and interesting to you guys. I hope you understand sort of the thing I'm trying to go through. And I know this stuff is complicated every single day, and that's kind of why I do it, because I always have something different to share with you and new data to show you. So please share your thoughts on these things. I always like to hear it. And I'll catch you all in the next video.